Blake, great to catch up once again.
Great being here, Mike.
Tell us about opportunity zones. What are they?
So the Opportunity Zone program came into being as part of the 2017 Tax Act. And actually, it was designed under the Obama administration, but actually passed Congress during the Trump administration. And so it's actually one of the most bipartisan tax bills that we've had in a few decades, although it has become a little bit politicized over the last 12 months, being an election year here in the U.S. And so the idea is that there's these millionaires and billionaires with locked up capital gains sitting in various assets. It might be tech stocks, it might be real estate, it might be a 2 or 3 generation company operating business. And so the idea is to encourage taxpayers to bite the bullet, generate that capital gain, and the federal government will provide you a benefit in the form of a tax deferral and then ultimately a tax exemption from appreciation on the assets that you reinvest in. The hook in the program is that you have to invest that capital gain into either an operating business in what's called an opportunity zone or a real estate project in an opportunity zone. And these opportunity zones are defined by census tracts throughout the United States as well as territories of the United States. And there's over 8,700 of them throughout the country. And each governor in each state was allowed to pick the specific census tracts based on criteria that Congress gave them. They were poorer neighborhoods, had high incidence of poverty and a few other conditions. So that's how it evolved. And so just running through quickly, if somebody sells an asset for $1 million, has a capital gain, either long-term or short-term, can be any asset, piece of real estate, could be Bitcoin they sold, publicly traded stocks, or a private company. They sell that, they generate the capital gain, and the general rule is you have 180 days to roll that into an opportunity zone fund, and then after it's in the opportunity zone fund, you have a minimum of 55 months or maximum of 55 months at the moment to invest that either in real estate or an operating business. First step, once you roll that, you defer your capital gain until 2026. You pay the tax in 2027, and then let's say that $1 million grows to $3 million, your investment, and you sell it after a 10-year hold. The $2 million appreciation in that asset, you never pay federal tax on that. All but 4 states have conformed, and so you'll also get a tax-free treatment on the state side. California, North Carolina, Mississippi, and Massachusetts are the 3 that didn't conform for the most part.
A recent Council of Economic Advisors report an estimated $75 billion in private investment has gone into disadvantaged communities in the 2 years since the program was created. Are you surprised at this success?
Not at all. And there's a national firm, Novogradac, that has been tracking the amounts going into these various funds, and so I was happy to see the White House number. They did use some extrapolation, but the bottom line is I've formed over 50 funds for clients, and virtually none of the money that's in these funds is in either the White House report or in the Novogradac report, because there's no need for us to report these. Usually the people that are reporting their numbers are those that are trying to raise funds out in the public, and all of my opportunity funds are self-funded by wealthy individuals, and they don't need to go out to the market to generate more contributions. And I think personally, I think the 75 billion is a low number. And the other thing to keep in mind, that's the equity that's been put in these. And these projects, most of them are real estate projects, and so they're going to have usually a 4 or 5 to 1 debt to equity ratio. So the projects that are represented by that 75 billion will be 4 to 5 times larger, because they're going to get debt financing and to do these big projects.
What sectors have these funds mainly been directed into, though?
So the stats are that probably 85 to 90% are real estate projects. So you've got everything from building office, high rises, at least those were happening pre-COVID, and they're still continuing. You've got hotels, again, another sector that's hard hit by COVID. You've got commercial buildings. I have clients in every facet of real estate doing these. I have a couple of one $3 billion, one $2 billion mixed use projects. I have one that's repurposing a casino to turn that into residential. So just a variety of projects, and I have a number of hotel operators that are building these. But what's unique in my practice actually is about 30% of my projects are operating businesses that are getting tucked into these. And I love, from an economic development standpoint, and I've done economic development for probably about 25 years in my practice, and that's a lot more exciting to me because of the job creation and the sustainability, and I think you make a more long-term impact into these communities with an operating business than you do with a construction project that's kind of short-term job creation. And then you're going to have people obviously working in those buildings, but I think the multiplier effect is much greater on an operating business.
There's substantial tax benefits for investors. What are some of the best examples that you've seen of that really benefit both the community and the investor?
Well, I consult for a couple of large counties in California and a couple of cities, and so even these are still on the drawing board, but we're looking at using these as public-private partnerships. One could involve a water treatment plant that's needed, and bring in that private money, and obviously the government agency needs that in their city. And then also could be a cogeneration plant to produce electricity. Others that I've seen them used for building new civic centers. It's pretty unlimited, and it's really really opened up a lot of avenues. The other thing, I'm involved in a couple of incubators that were already being formed, but the Opportunity Zone layered in there, the Opportunity Zone program layered in there. It's great for fundraising, as well as these companies launch to get that second round of financing, and then we'll move them into Opportunity Zone locations for the long-term benefit.
What kind of Opportunity Zone investments then have the greatest potential for post-COVID recovery, besides a winery, of course?
Well, yeah, we love that sector.
It's a lovely sector, but moving right along to the other sectors.
Right. Well, I have clients involved in the pharma business, and that are COVID related. I have another company involved, COVID related, that will be involved in disinfecting, buildings and offices, as well as food establishments. And so there's those are I think very good good businesses. I've got one in the city of Baltimore, and it's a WeWorks type, but on a much higher level, where they have a whole lot of business collaboration, incubators in there, food service in there, and that there's a whole bunch of business models that actually became better after COVID. And people, we have 700 employees, we have 13 office buildings that we lease parts of, and we're not going to need as much space going forward post COVID. And so these work sharing spaces are pretty hot commodity, and give people the flexibility. And then another one is I've got two ironically ghost kitchen projects where, again, you're going to have the restaurant business pretty decimated, predictions of 50% closure of restaurants. And so the ghost kitchen concept is again, it's shared space, lower your cost. Maybe people will use food trucks or Uber Eats or some other system to get the food to the ultimate client. Also, will have rooftop dining, so people that do want to eat in, it'll be open air. So a whole bunch of different ways to use the program. And but yeah, we've seen a lot of pivoting in business plans as a result of the COVID impact.
How do investors then identify how or where they should invest in opportunity zones? As I would imagine one of the first calls is Blake Christian.
I do get a lot of calls. Probably I get more calls from promoters of opportunity zone funds saying, hey, wouldn't your clients be interested in this? The problem with a lot of what I call the public funds that have gone out and raised large sums of money is the fee structures in those opportunity zone funds are often pretty high, and so you have to be very cautious of what their fee structure is. As I said, most of mine are wealthy individuals that have had large exits, and so we control the fees. They just really have their internal costs of running it, and then the outside fees of the attorney and the CPA, and then they're pretty much off to the races, and they can they're going to keep most of the appreciation. So that's but I do get calls from individuals, and there's a handful of funds that are quite interesting and have some what I view as some good upside. But there'll be also an interesting secondary market that'll evolve, I think, in the next few years to buy some of these more mature projects that are already in place.
If somebody wants to find out more, how would they contact Blake Christian?
Right. So the easiest way is through our website, www.hcvt.com, hcvt.com, and
that's it.
Or just Google Blake Christian and opportunity zones, and you will find me.
Now, I wasn't going to do this, but behind the scenes, many things happen in the land of film. Blake, could you please hold up your glass of red? We need to see it because I haven't got one, and I'm very jealous right now. There you are. Okay. That's lovely. A good red too. A good red.
My Carroll Shelby glass with the Cobra on there.
That's lovely. Blake Christian, once again, thank you very much.
Cheers.